Hey, good afternoon, everybody. So, this afternoon, Charles Sachs and I are having a very cool conversation on tax efficiency or tax optimization for capital gains treatment utilizing strategic portfolio management. Charles is our Chief Investment Officer here at Imperial Wealth Advisors. He is a chartered financial analyst and has a wealth of experience on these topics. Charles, thank you so much for taking some of your time to chat with us here today and share some of this amazing information that we've been going over for some period of time regarding helping our clients keeping more of their money in their pocket when they sell a business, when they sell a substantial piece of real estate, crypto, stocks, art, or collectibles. I think that this information is very timely because the tax bite can be substantial when there isn't proper planning done in order to account for these mass liquidity events. So we'd like your expertise in explaining a little bit more about how you are leading the pack in our team in helping strategize and planning in a proactive fashion for our clients to make these events less painful from a tax standpoint.
Sure, Omar, glad to be here. Thank you for allowing me to talk today on this. And yeah, it's quite an innovation. It's been something I've been using since 2023, and it allows, just as you said, anybody who has a capital gain, that could be a short-term capital gain or long-term capital gain, to be able to perhaps reduce or maybe even eliminate that capital gain. It works by being able to defer that. And throughout today's discussion, I can get into a little bit more on the what, where, and how for this.
Wonderful. Typically, we know that federal capital gain rates can be as high as 40.8% for short-term gain sales for any assets that are acquired within or sold within a year of purchase, and can be as high as 23.8% for long-term gains whenever the asset is held for more than a year. Can you talk a little bit more about how maybe the jurisdiction that a high net worth individual may be located in can impact or further exacerbate that federal tax exposure?
Sure, some of the higher tax states include California, New York, and Oregon that have capital gain tax rates as high as 13.3, 10.9, and 9.9% respectively. So those will sit on top of the federal rates. And so take example for someone who has a short-term capital gain in the state of California, when you add that together, that's more than one half of the gain will be going in taxes.
Yeah, absolutely. We're typically used to hearing, Charles, that with proper planning, we may be able to substantially defer some or all capital gains in some situations. Some folks even explore avoiding capital gains tax by donating shares of their investments to charity or getting a step up in basis at death. So, can you dive in on exactly how this strategy works and what makes it different from that more commonly taken approach?
Sure, Omar. First off, it's an investment strategy, and it's great in that this literally can wrap around an investor's existing portfolio, whether they be in cash or other assets in a taxable portfolio. And what it does is it builds a market neutral long and short exposures on top of that. So if we talked about this, let's say somebody had $5 million in a diversified portfolio, that could be within stocks or bonds, mutual funds, ETFs. They can use this in the account, and the strategy will buy additional both long and short stock positions. For every dollar long, they'll also have an equivalent short position that will give them a market neutral exposure, which is great because now this is not beholden to any particular market moves. It can work in up markets, down markets, and just neutral markets as well.
Awesome, awesome. From a conceptual standpoint, it sounds intriguing, it sounds appealing, but can we use some solid hypothetical examples of where this investment strategy might be beneficial to help offset capital gains? Can you provide some examples?
Yeah, you bet. Hypothetically speaking, imagine somebody in the state of Florida bought a home 5 years ago, cost them $2 million, and they just sold it recently for $5 million, meaning a long-term capital gain of $3 million. And so for that $3 million gain, assuming that they're at the highest long-term rate of 23.8% at the federal level, times the 3 million, that's a capital gain tax of $714,000 without this strategy. If they were able to use this strategy and take, in this case, they sold for $5 million. Imagine taking $3 million of the sales proceeds, and they can invest this in a portfolio that the owner selects, a mix of stocks, bonds, cash, whatever they did. And if they were to be able to put this in place on January 1st, assuming, let's say, that the sale happened on January 1st, and they built this portfolio and put this strategy in place also in January, deploying the strategy over that entire year, the expectation is to generate about 60% of the $3 million invested in a short-term capital loss. That would equate to a $1.8 million loss to offset. So whereas before they had a $3 million gain, if they have an offsetting $1.8 million loss, their new tax is on the $1.2 million. In other words, a change or keeping an additional $428,000 in the owner's pocket.
Wow, that's powerful. Charles, but one thing that comes to mind when you first hear this, are you saying that the owner's portfolio takes a 60% hit in order to generate this level of tax savings?
So not at all. This is using between the long, short, and the way this works. The portfolio is expected to actually have a gain within the portfolio while at the same time having losses. And while that sounds contradictory, realize that the gains will be unrealized, whereas the losses quickly realized. And so you can have both. You can have both a gain in a portfolio, albeit unrealized gain, and losses that are realized losses that one can use to offset an existing capital gain.
Okay, thank you for that. So, can you walk me through a scenario? And I know we're Floridians, and it's the perfect scenario because we only worry about the federal level. We don't really have to worry about the state level here. That's a perk of living in Florida. But can you paint me a picture in which someone, to use an example you gave earlier, let's say a business owner from Oregon, let's say they're being proactive, which is a rare thing. But let's just assume that they're planning to sell their business 3 years from now, and they're going to expect, let's call it a capital gain of $10 million. What does this strategy play out like in a scenario like that?
Yeah, so if you think about it, if business owners are doing it right, from the moment you start a business, they should be thinking about an exit. That exit could be 5, 10, 15 years from now, but they should be thinking about an exit. And the way this strategy works is the more time you have in advance to generate losses, the more you have available when that gain takes place. So imagine someone preparing to sell their business 3 years from today, yet at the same time, they've got some cash or stocks or something in a taxable portfolio that they currently have, and we can put the strategy in place in advance. In this case, we would have 3 years for the portfolio to run. So in our example, our hypothetical example, imagine a $5 million portfolio the client has, puts this strategy in place for that, allows it to run for 3 years. And so whereas in the prior example, we got about 60% of the invested capital, that was just year one. Over a 3 year period, the expectation is around 140% of the invested capital. In this case, 140% of $5 million is $7 million. And so a $7 million capital loss available. And so in your scenario, in case they sell, they've got a $10 million capital gain. They were prudent enough to get started 3 years in advance. They've got a $7 million offsetting loss there. So is without the strategy, their taxes on $10 million. In Oregon, you've got both federal rates at 20% and another 9.9 state of Oregon, almost $3 million in a capital gain tax without the strategy. Using the strategy as I described, getting started 3 years in advance, they're able to whittle that down such that keeping more than $2 million in the owner's pocket using that $7 million short-term cap loss.
Wow, truly powerful. I'd like to paint a different scenario. So let's say a crypto investor out of California doubles their money in less than a year. So we have a scenario in which now, let's say they invested 1.5 million. Now the assets are worth 3 and they want to cash out and invest the proceeds into their own chosen portfolio. How does this operate or how does this function in a scenario like that where we have short-term capital gain?
Sure. In this case, if you think about that, a short-term capital gain for someone who's a California resident, the combined rate is 54.1%. That's 40.8 at the federal level plus the 13.3. That would be the maximum capital gain, short-term capital gain rate for someone in the state of Florida. So in your example, they invested $1.5 million. They doubled it in less than a year, meaning it's short-term capital gain. $1.5 million gain multiplied by the combined 54.1% short-term capital gain rate is $811,000, little over $811,000. Using the strategy, then again, getting started January 1st within the year to be able to do that, the investor can take that full $3 million. That was the full proceeds of, let's say in this case, the crypto, and they could build out a diversified portfolio, cash, stocks, bonds, whatever they'd like to build out with that. And in this case, they'd run that 60%, the expectation, then again, 60% of the $3 million of invested capital, $1.8 million short-term cap loss. Remember, they only had 1.5 million. So in that scenario, they could completely negate that $811,000 of taxes due and have a carry forward of about $300,000 short-term loss carry forward over that they can use over their lifetime.
So there is a carry forward in this scenario, even though we're talking about short-term capital gains, huh?
In this case, right, so you can carry forward losses throughout your lifetime. They would be used to offset current year gains. Anything not used will be carried over your lifetime.
Okay, okay. So last scenario I'd like to play out here. Let's say that an investor in New York purchased a tech stock for say 1.5 million and now it's worth 2.5. They want to sell that position that they held for less than a year and invest the proceeds into a diversified US equity portfolio. So same scenario, different state, different asset class. It's not cryptocurrency. How does this play out in that case scenario?
Sure, in this case, then again, they held it less than a year, so they're privy to the short-term rates. That rate is 51.7% combined with 40.8 of top federal, plus the 10.9% maximum state of New York rate for that. So that multiplied, in this case, they had $1 million gain, and that's $517,000 that would be due. Using the strategy and taking that whole proceeds, in this case, the $2.5 million proceeds, investing then again on January 1st into a diversified portfolio that the investor chooses, the expected $750,000 short-term capital loss, assuming 30% of the $2.5 million invested. In that example, that capital loss reduces the capital gain from $1 million to $250,000. In other words, keeping over $387,000 in the owner's pocket.
This is phenomenal, Charles. But like always, like all good things in life, right? It must have its downsides. Can you talk at liberty about what are some of the considerations that sophisticated investors, first and foremost, I can already
Sure. So
tell that this is
it's a
something that
discussion we typically have both with clients and their tax advisor, number one. Number
sure.
two, this is a tax deferral strategy. So while you have those initial savings, you're lowering the basis in your positions, which means and eventually you'll be paying those, except for those two scenarios as you talked about. One would be a step up at death. Number two, giving positions to charity. Now, that being said, it could be thought of as a legacy position. So someone might have this 10, 15, 20, 30 years within their portfolio. If you think about how you've put this together, there may be no good reason to actually unwind it, and you might be able to have that unrealized gain as part of your portfolio somewhat indefinitely. So that's something to understand. Number two, let's say for sake of argument, you got down the road 5 years, 10 years, whatever that was, and wanted to exit out of the strategy, and you certainly can. Remember, you deferred those taxes and you deferred them using current rates, both federal and to the extent you have a state rate as well. Imagine down the road, 5 years, 10 years, whenever it is, if you decide to close out the strategy and realize those gains, you're privy to those gains, whatever they would be at the time. They could be higher, or you could have moved jurisdictions. It might work particularly well if you moved from the state of California, so you didn't pay the California state tax, moved to Florida. 5 years later, then decided to unwind the strategy. Perhaps you're paying only the state of Florida tax. If you turn that around, however, imagine that you deferred only state of Florida taxes and you relocated to California, and then you realized the gain there, likely you would be paying both federal and state. So the point is, there's a little bit of an arbitrage if and when you're winding this down, what those rates will be at any given time.
Well, thanks for sharing that. If I may ask, the strategy, as you explained it, uses long and short tax loss harvesting. And obviously, that involves the use of margin. We know that that's not always appropriate for all investors. So, can you expand a little bit more on that?
Absolutely. So sure, there's a little bit of complexity around understanding this strategy. And to your point, it does use a margin facility. So case in point, that's why number one, it's used in a taxable account. Number two, if you already are consuming that margin on the account, this won't work for you. So that is one disadvantage. You're giving up that flexibility to draw an account and use that liquidity. I would say in this scenario, people can look other places. Number one. Number two, they might bifurcate accounts. So a $10 million investor might do half using this strategy and half in another account to be able to preserve their margin capability from that piece. And so that's something one can certainly look at.
Thank you for shedding some light on that. I understand that the strategy does lend itself to generating ongoing capital losses. Does that present any income generating opportunities for the portfolio owner?
So yes, it does. Part of the strategy would be able to use think of someone exiting a business or sale of real estate. That first year, they might want to use all available losses to offset whatever capital gain they had. But rolling into year two, assuming they have no other capital gains, if they did an installment sale or something, then they will. But many times we see it's a sort of a one and done. So going forward, year two and beyond, one can start to use those losses to pull money out of the portfolio on a tax deferred basis. You could sell down or reduce the size of that portfolio, use those offsetting losses, and generate income, which is spendable income. That income can be used as spendable. You're not paying taxes on it now. You're then again deferring the tax of that portfolio.
Interesting. Interesting. I know that in the case of real estate and business owners, they could consider a structured installment sale in order to divide the capital gain over multiple tax years. And that would allow that strategy more time to offset more of the gain. I think that that should be our next discussion because I believe that there is a hunger for better understanding of these type of strategies, especially in the entrepreneurial community. And you have a wealth of information that I am not too shy on exploding. So I think that should be our next topic. But I want to thank you, Charles, for taking the time to do a bit of a deep dive into how we can use a client's existing portfolio to generate sufficient capital losses that can help offset the gains that can come from liquidity events such as the sale of a business, the sale of a property, the sale of art, cryptocurrency, appreciated stock. I think that this is very valuable to all of our clients and to everyone who relies on our expertise for guidance. So thank you so much for sharing, again, your wealth of information with us and the rest of our audience today.
Thanks for having me.
Take care.